sequentially. While the European production grew 7% in the quarter, this was largely due to Eastern Europe. Production in Western Europe grew merely by 3%. As explained in earlier calls, Metal Castello is experiencing a decline since last 2 quarters due to drop in the US market. Both these factors have led to stagnation in sales figures in Europe in this quarter on a year-on-year basis. EBITDA margin in Q4 C23 was 16.9% versus 14.5% in Q4 C22 and 17.2% in Q3 C23. As energy costs stabilize, EBITDA margins have consolidated around 17% and EBIT margin is around 13%. On page 12, we see the consolidated CIE India Q4 C23 results. Consolidated sales were INR 21.3 billion, which was 3% higher year-on-year. EBITDA INR 3.54 billion and EBIT INR 2.76 billion, both of which were roughly same year-on-year, and EBT of INR 2.45 billion, which was slightly lower. Please note that EBITDA, EBIT and EBT numbers of Q4 C22 include an amount of INR 378 million on the one-time profit on land sale. So the last year numbers are higher because of this land sale. The full year C23 results for our Indian operations are on page 14. Sales increased by 5% versus C22 to INR 55.3 billion. Automotive market growth in India in C23 was uneven across segments, quarters and customers. Light vehicles grew reasonably, but two-wheelers and tractors were underwhelming. The first quarter was good, followed by a muted second quarter, but the festive season was encouraging. The performance of our key customers was also mixed, with some suffering negative or flat demand growth. We had reported last year that all the business verticals were expanding capacity. There was a delay in ramp-up of some of these orders, especially at CIE Hosur and aluminum verticals, and this impacted our sales growth. We have positive expectations from these orders in C24. The EBITDA margin of 16.7%, EBIT margin of 12.8% and EBT margin of 12.2% are all higher than C22. EBITDA and EBIT were higher year-on-year by 10% and 12% respectively. Ahead, we expect to regain growth momentum in India while incrementally improving margins. On page 15, we have the full year results of C23 for our European operations. With sales of INR 32.8 billion, there has been a 10% growth vis-a-vis full year C22, largely in line with underlying market growth. Q1 C23 sales growth was strong, but the rest of the quarters were very weak. Positive exchange rate impact was offset by steel price increases. EBITDA margin in C23 was 17.8% versus 14.5% in C22, EBIT margin 14.5% versus 11.4%, and EBT margin 12.2% versus 10.9%. EBITDA and EBIT were higher year-on-year by 35% and 40% respectively in absolute terms. While the market forecasts in Europe are muted, we are quite optimistic about our European business, which has high margins, high returns, and very good cash generation. On page 16, we have the C23 consolidated results of CIE India. Sales were INR 88.1 billion, which is a growth of 7% versus C22. The EBITDA margin was 17.1% versus 15.4% in C22, EBIT 13.4% versus 11.8%, and EBT 12.2% versus 11.6%. As explained earlier, the EBITDA, EBIT and EBT margins and numbers for C22 include that one-time profit from land sale, which I have repeated quite a few times. The consolidated PAT in C23 is INR 11.25 billion versus negative INR 1.36 billion in C22. The C23 PAT includes profit from discontinued CFG operations that I had explained earlier of INR 3.275 billion. Adjusting for this, the recurrent consolidated PAT in C23 was INR 7.976 billion at 9.1% of consolidated sales. Likewise, the adjusted consolidated PAT for C22 was INR 6.735 billion after adjusting the loss of INR 8.475 billion from discontinued operations and the gain of INR 378 million from land sale in India. Thus, recurrent PAT in C23 grew by 18.4%. As we said, the recurrent consolidated PAT in C23 is INR 7.976 billion. The recurrent PAT in C22 was 6.735 billion, and this is the growth of 18.4%. And this has been achieved when the sales have grown only by 7%. So even in a year of uneven sales growth across geographies, market segments, and customers, CIE India has delivered an impressive bottom line growth. On page 18, you will see our abridged consolidated balance sheet, which shows the healthy state of CIE India. Return on net assets is 21.3%, the first time we have crossed the 20% mark. Return on equity is 18.8%, and ROE of continued operations is 13.3%. Net financial debt is negative INR 8.2 billion. So net financial debt is negative. The cash flows are shown on page 19. The company generated operating cash flows to the extent of 60% of consolidated EBITDA. Growth capex was INR 2.9 billion, 80% of which was spent on projects in India. Overall capex was INR 4.57 billion, which is 5.2% of consolidated, which is in line with our norms. Overall cash flow generation was INR 9.7 billion, but this includes cash received from the CFD sales process of INR 3.76 billion. The board of the company recommended a dividend payment of 5 per share, including approval in the AGM scheduled later in the year. This is double the payout made in the last 2 years. Section 3 of our presentation outlines our strategy. A combination of the following principles sets us apart from others, namely, make operations world-class, diversify customer base, plant locations and technologies, invest in a disciplined manner, continuously improve profitability, decentralize plant management, and focus on ESG. Diversification is key to our aspirations. In India, we are present in 7 technologies, 4 market segments, and more than 50 customers, out of which 20 plus of those customers are with annual sales of more than INR 500 million or 50 crores. This not only enables us to manage the volatility in sales at some of our anchor customers, but the portfolio approach helps us in protecting margins. Our disciplined approach to capital expenditure is encapsulated in a few key guidelines, and that is outlined in the presentation. We focus on improving productivity levels at our plants through a variety of projects, namely optimizing plant layouts, automating machines and material handling, improving cycle times, eliminating unnecessary operations and manning, and digitizing data capture. Teams from CIE Automotive Global help with know-how transfer. The success of our strategy can be gauged by the consistent improvement in performance over the years. Our EBITDA margins, PAT, free cash flows, and return ratios are quite close to CIE Automotive's global benchmarks. The key thing is consistency is what we aim for. The next section analyzes some long-term trends in the automotive industry and how we gain. As climate change takes center stage, electric vehicles or EVs are gaining traction. The pace of this transition to EVs is varying widely across regions and segments, and we are in that stage of uncertainty right now. We have developed a comprehensive strategy for EVs, and a selection of products that we pursue in the EV space under 4 categories has been shown in the presentations. Companies are increasingly expected to mind their carbon footprints, and thus there is a push for localization. Nearshoring also helps minimize supply chain bottlenecks. As developed nations seek to meet stringent CO2 reduction targets, some polluting processes like steel and aluminum castings are migrating to emerging ones. Lightweighting and safety are 2 key themes in the industry. The former will lead to a push towards materials like aluminum forgings and castings and composites, all 3 of which are focus areas for us. The transition to EVs, lightweighting and safety all require components with higher precision, closer tolerances and better quality. And this is where we think we can score. We think all these issues could lead to more opportunities, especially in India. The next few pages of the presentation present market statistics and forecasts from relevant sources, followed by the results submitted to SEBI in the prescribed format. The CIE India team is confident that it can utilize future opportunities and face future challenges with agility, in order to meet the shareholders' expectation of sustainable growth and profitability. Thank you very much. I've taken a bit more time than usual, so thank you for that. And now we proceed to Q&A.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handset while asking a question. Ladies and gentlemen, we'll wait for a moment while the question queue assembles. First question is from the line of Jinesh Gandhi from Ambit Capital. Please go ahead.
Hi. A couple of questions from my side. One is on the EU business. Given that outlook for industry is expected to be muted for next few years, how should we build in for EU business revenues, given the changes which are happening in the industry, particularly towards hybrids and EVs? Would there be content increase-led growth, or we will be largely mimicking underlying industry growth in EU?
Revenue projections in our European business, given all the changes in the market that is happening. For Anders' benefit, Jinesh, I'm just summarizing. So what he's asking is that the market in EU, the industrial market and also the automotive market is expected to remain not grow going forward. And then there are also changes like move towards hybrids and EVs. So in that context, how do we look at growth in Europe? Are we talking about stagnation or are we talking about increase in content per vehicle, etc.?
Okay, thanks. So, yes, you are right. This is Anders speaking. The evolution of the European market for the next 4 or 5 years will be flat. Okay, it will be a stagnant market in the automotive sector. Mainly, they expect a 2-3% drop for 2024, and the remaining years, absolute volume of car production will be around 17 million cars per year. Okay, that is the expectation. On top of that, we have in 2023 we had 12% of electric vehicles, and this percentage of electric vehicles will go growing. Probably a little bit slower than expected because there was a huge expectation of an exponential growth in the next years. This seems that is not going to happen. Probably the electrification will go slower than expected, at least 2-3 years of delay. That is what we all expect. And regarding CIE forgings, what we had this year, regarding the growth of our business in Europe, you saw that we had this 10% growth. The forging sector grew 16%, and the gear sector, Metal Castello business, had a drop of 6%. Okay, and this was mainly due to the export of the off-highway components that we are producing from Italy to US. Okay, so the US market in the off-highway business is now in let's say in the bottom side of the cycle. So the average is 10%, but you see that the performance of the different technologies or the sectors are different. For the future, what we are now seeing is that our new order book is really interesting. We are getting important businesses, both in the forgings and in Metal Castello, with a huge weight of the electric vehicles. In this year, for example, in the forgings, 73% of our new orders were electric vehicles, and in Metal Castello, 51% of the new orders were electric vehicles. So what we will see in the next years will be a transition from internal combustion engine components to electrified components for different customers. So what we expect is in that flat scenario or flat volume flat evolution business with the increase of the electric vehicles, we expect to maintain our business. So we see our future stable, and I think we are doing our job properly, and we are accomplishing the transition in a organized and solid manner. So we expect to keep this business in the near future in a stable way, according to the market evolution.
Okay, so and just to clarify, so are we indicating that we are not expecting any material increase in content as EV share in our business increase? Is that the right understanding?
Yeah, our EV share will increase for sure. As I told you that the new orders are coming, the majority from the EV sector. But what we can expect at the same time is that the internal combustion engines will start the decline. Okay, so I think our aim is to balance both, let's say, reduction and increase, and maintain or even increase a little bit our business in the future. So, but the expectation is that we will be able to make this transition smoothly.
Got it. And secondly, does this include any further ramp up in aluminum forging in Europe, or that will be over and above what we are talking about, stable revenues?
Yeah, we have, that we already got certain aluminum forging projects that we are now launching with different customers. We also got a very important steel forged component, but for the battery pack for the commercial vehicle, one important commercial vehicle customer. So let's say that all these projects are being developed, and both aluminum forging plus steel forging for the commercial vehicle battery packs, I think we will see good growth in that sector in the future.
Got it. And one last question is on the cash of 8.2 billion rupees. So how much of this would be in India and how much of this would be in Europe? And as a follow-up question on that, in case if we acquire something in India, can we access cash which is lying in Europe, or given the taxation policies, it might be difficult to access that? Thanks.
JP, will you please take that?
Yeah, I'll do that. So Dinesh, the Europe cash is all in that loan amount, which is about 45 million is with Galfor. And I don't know if you saw the stock. We are getting rid of the debt in Mexico by Galfor investing in there. So that cash will knock off the debt in Mexico of about $50 million. About moving money, so we'll be left with very little cash in Europe in the immediate. Of course, the businesses are cash generating, so we will have to find a solution around how to get the money for acquisitions in India. We are working on that. As of now, Dinesh, we don't have a solution which is tax efficient. India has, as you can see from the balance sheet, the standalone balance sheet, something like 7 billion in cash in India. So we are adequately cashed in India if we need to go for an acquisition. So I don't see an immediate challenge there. But you're right, we still need to figure out how to get tax efficiently money from Galfor. Immediately we have found a solution for the immediate, but for the long term, yes, we still don't have a solution which is tax efficient.
Got it. Thanks. I have a few more questions, but I'll come back in queue. Thank you.
Thank you. Before we move to the next question, a reminder to the participants, anyone who wishes to ask a question may press star and 1. Next question is from the line of Mahesh Bendre from LIC Mutual Fund. Please go ahead.
Hi, sir. Thank you so much for the opportunity. Sir, earlier we used to guide that based on the market growth, we'll grow 5% higher than the market. So whatever the blended growth of the market will be 5% higher than that. So what is the current quarter, performance as far as this guidance is concerned, and going forward, what is the outlook for this?
Okay.
That is it for India.
Yeah. Let's say that our business this year, this last quarter grew about 5%, and let's say the weighted market grew 3.9, something like that. So we were up slightly higher than the market growth this quarter. But you are right that we are below this 5% of, let's say, higher sales that we were expecting. There are several reasons for this, let's say, limited growth that we had in this quarter. Mainly, and I would say that the main reason is that the delay of some of our main big projects that we were launching in. The projects that we were launching in our different plants. Okay, especially in Ilforge, that we had these electric vehicle businesses for Europe that has been delayed, as you all know, and also in the aluminum business, where we get nominated for several electric vehicle components, and those projects has been delayed. So we are not concerned at all because of these delays. I mean, it's just normal delays because of the new technology entering, and okay, there are certain challenges for the customers to launch these projects. Sometimes it's related to the market, but sometimes it's related to the supply chain that is not well organized yet. But we are receiving the feedback from the customers that this growth will come in the next quarters. So that is one of the reasons, especially in India. And regarding Europe, the drop is coming from the Metal Castello business that I explained. In the last 2 quarters, we had a drop because of the cyclicality of this business for US, and also as you know, in US we have the elections at the end of this year, and let's say all the big infrastructure investments are stopped until the new team, the new president is elected. Okay, so let's say that we are now in a transition period and waiting for this. But we are, as the order book during all this year has been really, really good, and we are now launching also additional projects, we will see the growth and the recovery coming soon. So, in my opinion, it's just a transitory situation because of different reasons. But I think the market is solid. The evolution, the new projects are also coming. The interest from the customers is also very high. So we will see this growth trend to recovery again.
And Mahesh, just to add to what Ander just said, there are 2 other factors which, of course, that's a part of our business context in which we operate. One is, of course, the steel price decrease this year was pretty much affecting the revenues, the big amount, and also the transition from old Scorpio and Bolero to new Scorpio and Bolero, where we have a very large stampings business with M&M, and that was the difference, which both of these you will not see much of that in C24. So of course, that's, as I said, that's a normal part of the business context in which we operate, but these 2 factors unfortunately have added to the various delays that Ander talked about in C23.
And it's also important to highlight that in 2022, we had a growth of 28%. So we, let's say, went much higher than, let's say, the market. This year we have this 7% growth that is more or less aligned with the market, with the comments that Vikas made about the raw material decrease and also the certain important projects that are now changing. So overall, I think that this is just a transition moment that we are now accomplishing, and in the near future we will see again the growth coming back to our business.
Sure. Sir, a delay at ramp-up at Bilforge and aluminum business, was that because of the client or is it because of the our limitations that we could not scale?
No, it's just the delay from the customer point of view. I mean, we are waiting, we are ready, we have all the investments and all the machinery ready to start, and there is a delay from the customers. Okay, they have their bottlenecks, not in our company, it's in other bottlenecks, and we are waiting for them to solve these bottlenecks and to start the delivery. They promise us that we will start soon delivering at the maximum, at the peak level.
So this is export order, sir?
Yes, it's export order, yes. Export order for electric vehicles, yeah.
So it's a mix. Export orders for the electric vehicles is what Anders said. We have also talked about in aluminum is EV orders for domestic. So some of these EV projects is what we are observing. As you know, you see in the initial remarks, we were talking about how some of these EV projections are less rosy compared to what it was only 6 months back, and we are seeing that effect in delays in some of the ramp up of some of the EV projects. That's just an observation. As I said, that's really part and parcel of the business context that we operate in, and we expect those to start going up again this year.
Sir, is it possible to share for CY23 what was the export from India?
Exact number we'll have to check.
Something like 13% or something like that. No, we will give you now. I mean, we are calculating, but it's between 11 to 13%.
And sir, once this orders get sorted out, do you think this will go up significantly? Maybe 20%, maybe over the next 2-3 years?
Yes, what we see is in certain technologies we will see this export rate to go up. Okay, clearly in the casting division the gears are also growing, and probably the forgings will grow up also. We see a lot of demand from the customers to export the components, but you know that with all these geopolitical difficulties with the logistic bottlenecks that we have had in the Red Sea and so on, there is a mix the view on the customers, and probably you know that our preferred route is the local to local, where we can deliver in each region the products that we produce in each region. Okay.
So, sir, last question from my end. So, for this year, is it fair to assume that domestic business will grow 5% higher than our blended market?
Okay, I would say I am optimistic with that. Okay.
We don't make forward-looking statements, Mahesh, but that's a guideline that we follow over the long term. That's a guideline in India that we have always said that we follow. As I said, CIE is a very simple. We have very simple rules.
Yeah.
Like we said, for investment, it is 5 to 6. Capex is 5 to 6% of sales. So for India growth, this is the kind of heuristic that we have developed for ourselves. 5% plus higher than the weighted average market. So it is not it is something that we try and deliver all the time. But to say definitely, we will avoid definitive statements.
Yeah. And
I'm just checking the guideline only. I'm holding last 2-3 quarters we have not been able to come out with this kind of. So I'm just asking whether we are holding up this long-term, guidance. Going 5% above the weighted average of the market. So are we still holding it up, or there will be change for the next year?
No, we are holding it. Okay, we hold it. Perhaps with a delay of 1 quarter or 2, but I think in the midterm we will go for that for sure. Okay, that we are quite optimistic on that. And also, we checked that now the amount of export we had is last year was 14% of our turnover. Okay, it's a little bit higher than last year, 14.
Sure. Thank you so much, sir.
Thank you.
Thank you. Next question is from the line of Bharat Seth from Quest Invest. Please go ahead.
Hi, good morning, Ender and Vikas, and thanks for the opportunity. Vikas or Ender, I think in our presentation on Indian slide, we have shown that we have approximately 50% plus clients, and out of which around 20 are more than 5 crore or 550 million. So there is a long tail end of 30 plus customers which is not meaningfully contributing to the whole our sales. So what are our plans to ramp up those products and generate what we are talking of growing higher than the industry rate?
Yeah, of course. So you have basically the answer is in the question itself. So yes, we have opportunity to grow a lot of those customers, and we are looking at growth, and that's why we said this portfolio approach works. Some of those customers will definitely become big, and that is why we are confident that in the long term, market for us growth would be there.
But is there, this 50 plus customer, how was the same number and 20 plus more than 50 million last year, and how it has changed, and exactly when do we think that we will be able to really, grow the whole 50 plus customer to more than 50 million?
No. 50 plus over 50 million is a huge target. That in a B2B kind of business, that is a very high base. So all that we are trying to say that is we have a very robust portfolio approach. So we have very good anchor customers. So if you look at the customer pie also that we have presented later on, you will see we have very good anchor customers who are very large, and we also have a large set of other businesses who are emerging with us, who we are trying to grow. So between a mix of these anchor customers and the set of emerging customers, we are able to ensure both growth and profitability. That's the point. It's simply a portfolio approach that we are following here.
Meaningfully, when do we expect those really to, and each one will maybe having our different auto or two-wheeler tractor or MHCV. So if you can say some color in which segment they are sitting large pie where still there is a headroom to grow.
No, there are lots of such new customers that we have added in the last few years. We have talked about it in the past, whether it is Hyundai, Kia, whether it is John Deere, whether it is Royal Enfield. There are a whole set of such customers that we have added post-COVID. If you look at our track record from 2020 onwards, you will see that this kind of customer addition has accelerated during that period. A lot of export customers have been added also, as Ander was talking about. So to that extent, who will ramp up? How much will they ramp up? That's exactly a question we can't answer. As I said, some will ramp up. Of course, internally we keep looking at it, but the point that we are trying to make is this approach gives us stability both on growth and profitability. That's what we are trying to present.
Okay. And can you throw more, export opportunity? Of course, we are always, near shore kind of a thing, but still we are around 11-13% in 23. So next 2-3 years, where do we like to see kind of our export of the total India export from India?
So it is 14% is what Ander clarified.
Okay.
Because both the domestic and export opportunities are growing. So there, as Ander explained, there are two sets of contending principles that are happening. You also have the localization principle that is working. And of course, as we explained even in our talk, because of environmental norms, there is of course a movement from the developing to the emerging world in certain technologies, castings, aluminium. Over and above that, we have forgings and gears where we have other export opportunities. So that is, that was what Ander also talked about. These four businesses where we are targeting export growth and where we do see a lot of export opportunities coming our way in the next 3 to 4 years. So it is basically steel and aluminum castings, gears and forgings in that order.
And would you like to give some kind of a margin side? Where do we like to see in 24? India as well as Europe?
Europe margins are consolidating around 17% EBITDA, and in India also it is around the same number. As we say, we will keep on incrementally improving it. You know, the CIE global benchmarks are a little higher than that. So our job is to keep moving towards those numbers as much as possible. But that's what we intend to do going forward. But exact, as I said, 2024, we will not give a sort of forward-looking statement on what the margins are going to be.
Thank you and all the best.
Yeah, thank you.
Thank you. Next question is from the line of Nitesh Reje from Chris Capital. Please go ahead.
Hi, thank you for the opportunity. Just wanted a clarification. So could you please elaborate on these exports? So is this new business or, are we just moving CIE manufacturing from EU to India? And also, is this CIE India factory in EU or is this the CIE parent factory in EU?
No, these are new opportunities largely. As I said, it is in castings, in steel castings. Steel castings, we don't have any CIE factories in Europe in any case. So we have forgings and gears. Some opportunity coming, where we are, we have a aligned supply chain, say, between our gears business in India and Italy, and we work together to supplying some of the customers. But that's a small part of the exports opportunity. Please realize that CIE in Europe does very well on margins. So it's not as if that, they are wanting on that aspect. So largely it will be new business.
Okay, got it. And just, with steel price deflation, which you mentioned, shouldn't margins optically, in fact, increase?
Some impact optically will obviously be there. As there is an impact on revenues, there is an impact on margins also. Yeah, there will be some impact.
Okay. And, calculating EBITDA margin on in the normal way when we're not considering other income and revenue and considering other operating income, our EBITDA margin comes at 15.3 for CY23. So what is the outlook on that? Because earlier we were expecting an expansion in this EBITDA margin.
No, we calculate it on sales, and that is the way we present it all the time. When we talk about EBITDA margin of 17%, that's on sales. That's the way we present the data, and you'll have to look at it from a sales perspective only, EBITDA by sales. And that we have said that the CIE benchmarks are higher, and we would like to meet those benchmarks in the medium term is what we have. Again, a very simple rule that CIE follows. That's the rule that we are following as far as the margins are concerned.
So when you say the medium term, that is what, 2 to 3 years?
Yes.
Okay. Got it. Thank you so much.
Mm-hmm.
Thank you. Next question is from the line of Priya Ranjan from HDFC AMC. Please go ahead.
Yeah, thanks. Just a couple of questions from Ander. Since I think around 70% of the business is broadly now coming from India, so how much time do you spend in India? Because I think the Indian management or Indian team has, when the Mahindra was declining, you were saying Mahindra was declining, that's why I am declining. When Mahindra is growing, you are saying, probably we are a little bit moving ahead of Mahindra. So what is happening with the company? Either the consistency of the local management is not there or their focus is not there, or, you should, whether are you giving enough time to the local management, or are you not taking cognizance of what is their underperformance in the last 10 years?
No, I would say that the local management is doing fantastically well. Okay, I think we can say that we have a very solid, very professional, very well aligned local management, and I rely 100% on their capabilities and their knowledge. Okay, so we are, I think, a fantastic team working together, and I'm spending approximately, I come to India every 2 months. Now, next trip I will come in mid of April. So we review operationally, and otherwise we do it every month. We check any of the verticals of the company here in India. We review with the management through teams in detailed manner. Okay, so I think the management system is working. Everything is well structured. I think that the team is also well aligned, and the ideas, the strategies, and the alignment of the team is very clear. Okay, so I'm really comfortable with that. Then the reality of the market, and sometimes some of our customers, they did better than the others, and some sectors are still depressed. For example, this year the tractor sector was a little bit depressed, and also the two-wheeler, except the last quarter, was also affecting us. But the long-term or the mid-term view is positive. On top of that, we are getting new orders, and we are getting new projects, and the collaboration between the European and American CIE teams with the local teams is also improving. So overall, I think that the integration of the Indian business in CIE is complete. I would say that we are now in the better shape than we have ever been. So I can only be very optimistic about the future of our Indian activity. It's true that we would like to have some more sales, some more turnover. That is probably the only thing that we need this year. But as the projects are there, and the customers are confirming, and they are pushing, and they are saying us that they will come, for sure the growth will come. So let's say that we are in a very solid company with a good management, with all the customers also supporting us because they see a very reliable company. That's the message that I was trying to give during all this year working together with the local teams. We need to be a solid, reliable, good quality, good delivery company. And in that sense, I think we are an outstanding company in India. So the customers will come, and the customers will appreciate this, and they are already appreciating this in the market. So I think that the management and the evolution of the company will be positive, and in CIE we strongly believe that the growth of in the near future will be mainly in India. Probably the best country to develop the business will be India. Perhaps some in Mexico also, because Mexico, because of the situation of the US, is also another growth focus. But India and Mexico will be the winners in the next years.
Priyaranjan, so just to add to that, of course, Ander has talked about the local management. I'll not refer to that. Now, you talked about Mahindra. Please be assured that we are not neglecting any of our anchor customers. So when we say that we are diversifying, we are not diversifying at the cost of our strategic customers. Not at all. Whether it is Mahindra or Bajaj or Maruti or Tata Motors, we are extremely focused on supporting them in their growth process, and we are actually growing with them. All the other effort that you see is not at their cost. That is something I need to clarify, since you did mention that now we are trying to move away from Mahindra. We are not. We are just adding more customers as our capabilities grow. I will again refer you back to what Ander sometimes said just before COVID in 2019. As our capabilities grow, and he was asked that question about growth in 2019, and he said at that time that the more capabilities we have, the more we'll be able to grow, and that is what is happening. So the more capabilities we are generating, we are able to attract more customers. But please be assured that we will never neglect any of our key anchor customers. We are extremely proud to work with them, all the names that I took, and will continue to support them in their growth journey. As far as Mahindra growth this year is concerned, I did explain because of the old Scorpio and Bolero transition to new Scorpio Bolero, and we know that since the old Scorpio Bolero were old models, we had some outside stampings, external stampings, which are no longer made, which are all made in-house now. That is causing a drop along with the RM drop, which is significant. So that is causing a bit on the revenue side, but rest assured we are very, very strong with our anchor customers, and we will continue to be strong with them and will continue to support them with whatever they ask us. Yeah. Thanks, Priyaranjan.
Okay. Okay, all the best.
Yeah, thank you.
Thank you. Next follow-up question is from the line of Jinesh Gandhi from Ambit Capital. Please go ahead.
Hi. So one is clarification on the margin. So when you are referring to global benchmark, you are referring to 18 to 20% EBITDA margin.
Yeah, of course. CIE is roughly around 18% overall margin, and publicly stated they want to go ahead of 18%. So that's the global CEO of CIE is on record talking about 18 plus margin.
Right. Okay. And second question pertains to the India business. So when we are talking of EV-related orders coming in, so can you talk about how FY2023 shaped up in that context? What percentage of our orders came from EVs, both for two-wheelers and passenger vehicles?
No, as Ander mentioned, so in Europe, it was the forgings business of Europe was 73%. In gears business of Europe, it was 50%, and in India, it was roughly around 15%. Okay, so as you know, a lot of our orders in India are actually not ramped up as much, so that's okay. So overall, the portfolio, we are very, very comfortable because we already have a very significant and large portfolio in India already. So, and which we are, a lot of those we are actually waiting to ramp up.
Right. And of the total order book, say cumulative last 3 years, would it be fair to say EVs would be 10-12% of that order book as well?
In India? Yes.
Yeah.
Okay. And more in Europe.
Right. And second question pertains to Mahindra. Now, given that share of Mahindra has come down to 31%, how should we look at M&M, given that the new product side we have talked about having lower content because of insourcing on stamping side. Going forward, as we get more orders, particularly on the born electric vehicle side, how would you compare content in born EVs versus the newer products which we had got, for example, Scorpio and XU700 versus the older models like Thar and Bolero that way? So can you talk about quality?
New model, Bolero and Scorpio, of course, they are in a different league. It will be slightly lower than Bolero and Scorpio, but slightly higher than the other XUV500 and so on. So we are very strong with M&M on their new releases, both in auto and tractors. So as I said, we will support M&M. Of course, the content will not match what was there on the old Bolero and Scorpio, but as you know, but all that is being compensated by the number of models that M&M is releasing anyway. So that is not a problem, because the list of M&M platforms is now very large, and we are there almost everywhere. So that is not an issue.
Yeah, in fact, we are launching a new press line in May, June for Mahindra to increase our deliveries to them. So in 4 or 5 months, we will have additional capacity to cope with the additional demand coming from them. So I think there will be a growth also in Mahindra in the stamping division.
Yeah. No. As I said, last year there were a few things that worked against us. The transition. Now that almost 2/3 is the new Bolero, new Scorpio, so that will not impact the growth, and the RM is stabilizing. So as Ander said, we are not, from a volume perspective, we are really not bothered too much, concerned. Let me not use the word bothered. We are very bothered. We are not concerned that we'll not be able to meet the growth requirements or that we have in our mind. So C23 was a bit of an aberration that way, and we think we'll be back on track from a growth perspective. But having said that, and this is in continuation to what Priyaranjan had also asked, yes, on growth, we may have underwhelmed a little bit this year. On profits, we have grown, as I said, 18.4% that we pointed out. If you look at recurrent PAT in C23 versus recurrent PAT in C22 on a consolidated basis, the growth is 18%. So on every other parameter except growth, I think we have done extremely well. Whether you talk about our RONA, the way we calculate, I am sure some of you calculate it slightly differently, but we have crossed in our estimation the way 20% RONA consolidated figure this year. So you look at our cash flow generations, look at our debt. So if you look at it in a holistic way, yes, we do accept we have underwhelmed on growth, but on every other parameter we have done extremely well. And even on growth, as I said, there were some factors that worked against us in C23, and I think those will be corrected in C24, be it RM, be it the transition to the new models, or be it the ramp-up delays. So this, you will see, some changes, let's say, in the environment, in the growth story. But let me emphasize, other than that, in C23, we have done extremely well on every other parameter.
Right. Just to clarify on this, you indicated that the content in Born EV models of Mahindra which are launching from next year, we will be having more content than the Scorpio and XU700, but lower than the older models. That's the correct thing.
No. Let us not get fine. I'm just saying that there are three classes. One is, of course, the newer models, XUV700 is in the newer models. Then there are extremely old models like Bolero and Scorpio, and then there are the intermediate models which are like the XUV500 and the rest, which were, namely 3, 4, 5 years back. So that is the difference. So among the newer models, we have lower than the extremely old models, but little higher than the intermediate models that we were talking about.
Okay, but any indication on the Born EV side, how it will be there, given that those will be totally new platforms and new powertrains?
A lot of it is that right now, not all of those RFQs have been fully settled. So let them get settled, and then we'll have more of a indication on what is happening.
Got it. Okay, great. Thanks and all the best.
Yes, thank you.
Thank you. Next question is from the line of Pratik Kothari from Unique PMS. Please go ahead.
Hey, hi, good morning. So one on Metal Castello, if you can highlight, last year I think we did 80 million euros. Where are we this year? How is the trend panning out? Are we seeing bottoming out of what we used to suffer in the US?
Metal Castello.
Okay. Yes, Metal Castello last year, as I mentioned, we started it with the first 2 quarters with a very strong demand and sales, but in the third and the fourth quarter, we saw an important drop because of the, let's say, cyclicality of this sector in US, especially our main customer, Caterpillar. Okay. We expect to be at the weak volumes during the next couple of quarters until the revamp is coming in the second half of the year, and especially after the elections in the USA. So we think that is the evolution of our Metal Castello business in the next months. Also, we had to say that we had certain new projects with other customers, especially in the electrification field, that are also delayed, and the expected ramp-up of these projects is delayed, so we are waiting for that. So we are optimistic because these electric vehicle components that we are going to supply to the US are coming for sure, a little bit later than expected, but we are waiting for the ramp up from the customers. So together with the growth again in the sector, plus the new projects that we had, I think we will come back to the normal, the peak business when we were hitting the 80 million euros turnover in Metal Castello. Okay, so that the recovery that we expect right now, we can be at a pace of around 60 million. So we will see this recovery in the next quarters. So willing to get to that situation, and in the meantime we are quite, working internally to improve our efficiencies and to set up the factory and preparing the factory for the growth again.
Sorry.
So Pratik, just because last year was not as bad for Metal Castello, so it was a 6% drop compared to C22, not more.
Yeah.
So if you look at earlier during the call, Ander had mentioned that in Europe overall this year we have grown 10%. The forgings business, which is roughly 3/4, grew 16%, and Metal Castello declined by 6%. 6%. So that's that's the number, because the first quarter in Metal Castello was quite good, and this year the run rate is say 5 to 6 million euros, but it was doing about 80 million or 7 million euros in 2022. Yeah.
Correct. Fair enough. Then second question to Vikas. So 12 months back, our heuristic used to be for India business, India plus 10 was where we were very comfortable and confident about. Obviously, those were estimates and guidance and future forecasts, and things we didn't deliver this year, but it seems that our heuristic also has shifted from plus 10 to plus 5. So anything to read into this? How to think about this?
No. 5 to 10 is what we used to say even then. Of course, it's good that you remember the higher range, but it is 5 to 10 is what we used to say. That's correct. Right now, given what we have done, we are saying 5% at least to start off with. That's all. But it is always 5. We had always said 5 to 10% as far as the Indian market is concerned. Look, again, I am reiterating, there are some factors that went against us. The raw material decline has been a very big factor this year. In fact, in Europe, it is higher than even in India. So that factor, normally if it is 1 or 2%, it's okay. It's a bigger number than that. So that's, and as we told you about the shift in M&M, where we have almost 1,000 crores of stampings business with M&M, 800 to 1,000 crores, and on that transition is happening from the old to the new models, and therefore the growth is restricted there. So if M&M grew whatever that M&M auto sector grew 30% in C23, we were not able to utilize that entire 30% of the growth. And Priya Ranjan also asked, that are we moving away from M&M? That's not the case. We were not able to match that 30% simply because of this transition from old to new, and our stampings business, which is a very large part of the M&M business, almost we are probably among the top stamping suppliers to M&M. So these two effects, if you take into account, and of course, as I keep saying, that's part of the business context, so there is no point in fretting about it. But if I adjust for these factors, we have still met that 5 to 10%, but that, as I said, that doesn't count because these factors are part of our business context. So if you keep these in mind, you will see that, our volume performance is not not as bad. We are not losing market share. We are not, withdrawing from any customer or market. Nothing of that kind. It's just that, as I said, as Anders said, some of the orders didn't ramp up. There was this RM effect, and there was this old to new effect in our largest customer, and that's what has given that underwhelming nature to sales. It's as Anders said, it's temporary. It will come back. Plus, as I said, also please look at the other parameters that we have done very well on. As I said, an 18% growth in PAT. For the first time in our history, we have crossed an RONA of 20% on a consolidated basis. And so that's, those are other things that we have done very well in C23.
No, fair point. Just two clarifications. One, we said we have 20 customers in India which contribute more than 5 crores of business or 50 crores of business. So we said total up 50 and 20 is 5 crores.
Yeah, 5 crores is a substantial number to start off with. So when you start with a new customer, that's a good number to start with.
Correct, fair enough. And second,
over a period of time, as Bharat Bhai was asking, he also asked that same question, when it is going to ramp up. Some of them will ramp up to much bigger numbers, but not all.
Correct, sure. And second, we said exports formed 14% of a business and it was 10% last year. So it's a good 40-45% growth in exports that we observed this year. So one, are these numbers correct, and what is driving this? Because this is a substantial change.
No. I think it won't be 10. I think it would have been 11, 12 last year. We'll check the numbers. Yes, exports, we do expect them to increase, but in select areas that, that Ander emphasized. Definitely in steel castings, where you see this trend of castings moving away from Europe to other parts of the world. Therefore, you see that. A bit of that in aluminum castings. And of course, forgings and gears have always been strong in exports. From when I say forgings, that's largely Bill Forge, always been strong. So that will continue. So yes, there is optimism around exports, but you also have to understand that there are other countervailing factors. The supply chain bottlenecks. So there is a move towards nearshoring, like local for local, etc. So as I said, these are things that we keep observing. But we are very, very expectant on exports in castings, gears, forgings, and aluminum. 11%. Yeah, it is 11 to 14. That's the number. We are confirming that.
Right. Because that's a substantial jump too. No, great. Thank you and all the best.
Yeah, thank you.
Thank you. Next question is from the line of Nitish Reje from Chris Capital. Please go ahead.
Hi, thank you for the opportunity again. So could you please elaborate on your, inorganic opportunities now that we have close to 800 crores of cash? Also, are we focusing on any particular segment capability which we want to get through this acquisition? And which ones we are currently assessing, and what would be the optimal size of this acquisitions?
No, optimal size, that's the easiest to answer. We don't want it to be very big or we don't want it to be very small that it doesn't move our P&L. So it is, so we do look at, the two acquisitions that we have done were in the range of 600 to 1,000 crores of sales. So that we think is the optimal kind. But then, it depends on availability. To your other questions, where are we looking at? Of course, wherever there are gaps, we have always mentioned that, for example, we would be looking at, for example, in areas which are getting more prominent with lightweighting. We mentioned in our talk about how lightweighting, etc. are driving it. So wherever that would be happening, whether it is aluminum, whether it is plastics, or even in some customer wise, if we can get access to newer customers, so we will be looking at it. M&A, the way we look at inorganic is as a sort of complement to our organic strategy. It is not for growth purposes that we are attempting to do inorganic. We are attempting to do to improve our portfolio of capabilities within the company. So that would be the idea. Of course, right now we are not at a stage where we can talk about, as I said, inorganic is as much part of our day-to-day activities, but, at this stage, there's nothing specific that can be mentioned. We'll, of course, report it to the concerned parties when any such thing happens. But as I said, we'll also be careful about the prospects of value generation. So the pricing is also important. So it is pricing plus the kind of capabilities that the opportunity brings to us that would decide what we would do with inorganic.
Okay. We got it. And just wanted to understand what's the strategy with adding sunroofs to our portfolio. We've seen recently that peers like Gabriel have started doing sunroofs. So, and we've been a late entrant to the India market, and CIE Europe already has this. So, just wanted to understand the strategy there.
Yeah. Yes, we have analyzed this sunroof business. That that it's a global business that came from an acquisition that CIE did in 2019. Okay, this business is a centralized business. It's a tier 1 and product-driven business. Okay, so what we saw is that all the development, all the R&D is done in a centralized engineering center. That is, it is in Germany, and this business has it is a completely separate business inside CIE. Okay, it's not like part of our technological organization. It's just a specific roof system business, and it's managed commercially, technically, R&D as one unit. Okay, so in this moment we don't see let's say any reason to split this unit. Okay, so from now on we will decide this unit will be independent in CIE. It is the name of this business is Golde. This is the new name that we are using for this company, and it is managed independently inside CIE. So from now on will not be integrated in CIE India. Okay? Despite they have one production plant in India that is in the Pune area.
Okay, so we will not be looking at introducing sunroofs in the India business.
Not at all. Yeah, not in this moment.
Okay, got it. Thank you.
Thank you.
Thank you. Ladies and gentlemen, we will take this as the last question for the day. I would now like to hand the conference over to the management for the closing comments.
Yeah. So, as usual, thank you very much to all the participants for the questions, well-directed questions and very clever questions. So we hope that we answered properly, and we hope that you will continue having the faith and the trust on our company and the good evolution of this company. I also like to thank you to all our team here, as they are fully committed to deliver fantastic results, and in the near future we will see this growth and these good results happening again. So thank you very much to all of them.
Thank you. On behalf of ICICI Securities, that concludes this conference. Thank you all for joining us, and you may now disconnect your lines.